Hi, I'm Ashish Shanker, Head Investments at Motilal Oswal Wealth Management Limited. Happy to take you through the third series of Know Your Fund Manager. This is part of the Know Your Foresee Manager series. Today we have somebody who has a vast experience of investing in Indian equities, close to about 25 years. He's been investing in small caps for the UK group Ashmore for the last 9 years, and he's been investing in all caps for the last 8 years. Recently he's launched a domestic fund where he's the main stakeholder to talk us through his journey of investing in India and what he sees for equity markets going forward. We have with us Ashwini Agarwal, who's CIO for Ashmore India Opportunities Fund. Hi, welcome Ashwini to the show.
Thank you so much.
So Ashwini, you've had a fairly wide and rich experience of managing Indian equities. You were earlier on the sell side, you were heading equities for UBS as well as Kotak. We have had a very interesting last 3 years. I mean, 2017 has been a fantastic year for equity markets. How do you see the markets evolving from here?
Last year we saw a massive move in the market, which was driven by liquidity, especially the domestic liquidity coming into the stock market. Unfortunately, the earnings momentum was missing. So as a result, what's happened is that valuations have become quite rich. And at the end of 2017, I mean, we were looking at valuations which are well above one standard deviation from the mean, closer to the point where you would start to get worried as to when do you see the next leg of return. So this year what we are actually seeing is the earnings story unfolding, but no price momentum. And I think that for the next 12 months or so, given that we've got a very active political calendar, given that we have valuations which are still a little bit on the rich side, I think the right expectation to set would be that don't expect fireworks from the market. But the earnings growth story is actually turning out to be much better than what we were hoping for at the start of the year. And my sense is that in the next 12 to 18 months, you will again have the situation where valuation will become reasonable enough for us to expect gains from there on. Having said this, the market has again two parts to it. So there's a very high quality growth companies which are very, very expensive, and there's this vast area of underinvested sectors or disliked stocks. Some of them are going through their own cycle, whether it's banking or it's cement or it's real estate. And I think there are opportunities in these beaten down names which will actually give you absolute returns even in an environment over the next 12 months where you don't expect much from the aggregate markets.
Right. So that brings me to my next question. You have a very unique and clear style of investing in companies, and you often tread the path which no one else looks at. So could you talk us a little bit about through your philosophy and how you approach building a portfolio?
I believe that every stock or every asset has a fair price, and one of the things that we don't wish to do is pay valuations which don't seem sensible to us. So historically we've been very value oriented. We have always tried to look for value in a stock that we purchase. Value can come in three forms. It can be relative to the history of a stock, it can be relative to the peer set, or it can be relative to an absolute measure. So for example, we are sitting in this lovely office of Motilal Oswal. There is a market price for this asset, and if I were to buy a holdco of this company which was valued at, let's say, 20 cents or 30 cents to the dollar on the underlying asset, that would become an absolute value proposition to me. So we've always looked for value, and one area where we find value to be extremely rewarding is when you're able to buy a good business going through a bad time. All businesses go through cycles, and if you're lucky enough to buy a really, really good business going through a bad time, then you can make serious money as the business conditions normalize. So that's the core to our investment philosophy.
Could you elaborate on that by giving us some examples of companies which have made money for you in the past, and what was the thought process while you were making your investment decision?
One of our biggest successes in the last 5-7 years has been Maruti. We invested in Maruti in 2011. We started buying Maruti at a time when everything that could go wrong was going wrong for them. So the yen had appreciated, so they were getting hit on the raw material side, on the cost of their imported components. They had a labor problem which was slowly brewed into a massive strike, and unfortunately one gentleman died in the violence that arose from there. Toyota and Honda both were making aggressive noises about their interest in the small car market in India. So, here was a stock, okay, which had no debt on its balance sheet, was generating cash flows year after year, and the valuations were completely beaten down. Margins had fallen from 17-18% down to 13% at the EBITDA level that year. And, our sense was that here is the company which has a distribution strength which is unmatched in this country. So if you looked at the numbers even back then, Toyota and Honda had dealerships which were less than 100. In comparison, Maruti Suzuki was available across 2,000 touch points. And in this country, it's very hard for you to make a customer if you are not even present in a city. So if you went to, let's say, an Aurangabad, or you went to a small city, somewhere in UP, most people would want to buy a vehicle from a dealer who has a presence in that city, because that way they are assured of service, they are assured of spares, they are assured of being taken care of. And in India, a car is an expensive purchase, so people can't take chances. They don't want to take chances. So when we looked at it, we said, look, this is a great brand. This has got a great distribution. The product makes sense. And truth be told, in the Honda or in the Toyota stable, we couldn't see any vehicle which could come close to 3 lakhs of rupees as a price point. So we said that, this entire noise about competition increasing doesn't make sense. The labor problem was something different, but we saw things coming to an head, to a head with the lockout and with the deaths, unfortunately, that happened, and we felt that the solution would emerge. Typically when problems become too large and something goes wrong, that's when, a solution finally emerges, and that did happen, in the subsequent 6 months. So we invested, at a price which was around 1,200, 1,300, 1,400 rupees. We saw a 20% loss in value in the first 6 months of our purchase, and every auto analyst on the street was telling us that we are going to lose our shirt on that. So, that was a hugely successful investment for us, a great example of a good company going through a bad time, and you buy it and sit tight.
Right. The other thing that I picked up during the course of my discussions with you is that you also have a strict sell price for most of the positions in your portfolio. How does that work?
Two is that, in our internal discussions, based on peer set, based on historical values, based on, various parameters that you can look at, you can come up with a multiple, a price earnings multiple, EV to EBITDA multiple, DCF. You can cut this, you can slice the valuations through using many different approaches, but then you come to a certain number where you believe that the stock is fairly valued. And our philosophy has always been that if a stock becomes fairly valued, you should sell it. In the past, very often when we've looked back and analyzed, yes, there will be the odd case where you sell a stock and it continues to do well for a long period of time, and you look back and you wonder if you made the right decision. But in more cases than not, we found that selling a stock at fair value actually adds a lot of value, because when things become expensive, that's what they are. They're expensive. Their ability to beat the market from there on becomes very, very hard.
So for the benefit of our viewers, I mean, we always keep getting asked, what's the right price to sell? Is it static number, or is it something that is constantly evolving and dynamic?
The valuation parameter might be static, but the numbers evolve. So earnings go through upgrades, they go through downgrades, the outlook for a company changes. So it's a dynamic process in terms of keep evaluating your investments. But let's say you have a price earnings multiple target that I'm going to sell this stock at 25 times, next year's earnings. And, that 25 times may not change. That may remain the same, or it may change based on what's going on. So you look at the evolving earnings trajectory of the company, the evolving valuation parameters applicable to that industry, and various other inputs that go into it, including the discount rate, for example. As interest rates rise, your valuations logically should keep coming off. So you manage the process dynamically, but the whole idea is that at every point in time, you should have a very clear idea about where you're going to sell the stock. What we have never done is it's kept with momentum, with earnings momentum. So in the sense that, very often I meet, very highly successful investors who say, oh, but this company is growing at X%, so long as it's growing, I don't want to sell it. I mean, and it's worked for them, but somehow I'm not able to personally come to terms with that, because if something becomes really expensive, it doesn't appeal to me. I mean, Hindustan Lever is a case in point. I mean, the stock trades at 50 or 60 times earnings with 12-13% earnings growth. I mean, I don't know why it trades there. I mean, it's a great company, it's a great management.
And it's still been the top performing stock last year.
The top performing stock this year.
So, Ashwini, any company that you bought didn't work as per your thesis, and eventually you had to throw in the towel and sell. I mean, is there any example that you can give us, and at what point do you decide that this stock is not worthy of a position in your portfolio?
Yes, it does happen to you from time to time. I mean, the thesis of value investing, like I said, is that when a good company is going through a bad time. So sometimes what happens is that you make a certain thesis that this is what will cause the bad time to get over. This is how that story will evolve. Sometimes that doesn't happen. Sometimes those bad times continue, and management changes, or people or business dynamics change to a point where you have to look at the stock and say, well, you know what, I was wrong, and you move on. It does happen. It happens from time to time. I mean, there would be examples across industries where we've seen that happen. I mean, Tata Steel was one case. It's an extremely successful stock today, but we bought it at a point in time, sometime in 2010 or 2011. Where we expected, a certain level of profitability from the domestic operations and from the international operations. Not only were those numbers missed, but a whole bunch of other things started to go wrong, including, the pension liabilities in UK and various other things, and their indebtedness became so large that we started to question the investment thesis. And at some point in time, we felt that, look, this won't work, at least not in the way we had thought about it, and we let it go. Obviously, since then, steel has again moved from a surplus to a shortage, thanks to the cutbacks of production in China over the last 12 to 15 months, and the stock has come back like all other metal stocks. But that's something that wasn't visible in 2013-14, when the stock was going through a really rough time.
So you've been managing equities for the Ashmore Group for more than a decade now. Recently, you have launched a domestic fund. So could you tell us a little bit about the thought process behind the launch of this fund, and what is the approach?
The thought process or the motivation to launch this fund came from the fact that we've been managing money for a long period of time, like you said. So my colleague and partner Rashi Talwar Bhatia, she and I have been working together for the last 11 years. I've been here for 12 years, she's been there for 11 years. And about 2 years ago, we sat down and we said, okay, what do we do next? And one thing that we really wanted to do was manage our own money, which was lying in different mutual funds or third-party managers. Some of it was invested with Motilal Oswal as well. And we felt that it didn't seem right that we should be in the money management business, but our own money should be managed by others. It somehow didn't sit well. So there was a huge passion to do that. Very often friends and family had approached us saying that, would you manage our money? But all our funds were offshore. For the Ashmore Group. So, for domestic savers, we had no solution to offer. So, a couple of these things came together, and we said, maybe we should do a local fund. The alternative investment fund guidelines had come in, a couple of them had been launched. The whole regulatory aspect of it had started to fall into place. So we felt that it was the right time to do something, and that's how we launched the fund. The philosophy behind this fund is exactly what we've done through our investment career at Ashmore for the last decade, which is value investing. and it is in the small and mid cap space. So between 2006 August and 2016, Ashmore had a small cap India strategy. And we replicated this fund exactly along those lines because we had managed it over a decade. We knew, we knew what our track record was, and that actually inspired us to say that, look, if we can do it, if we know what we've done well, then we should be able to replicate it. And therefore, everything in the fund was replicated along those lines, including the value framework and the fact that we would invest in companies up to roughly $2 billion in size, so which is about 12,000 crores of rupees at the time of the launch of the fund.
What made you choose small caps as a space?
Multiple things. One is the fact that we had a track record of investing in small caps, and we've done a reasonably good job with that. The second is that, my hope is that the entrepreneurship which is inherent to so many Indians, that gets those opportunities become available to you through the small cap and the mid cap space. And when we say small cap, it's actually not as small as someone might imagine, because we are willing to look at anything which is less than 12,000 crores in market cap. So you can invest in medium-sized companies as well. So the other feeling that I have is that smaller companies have a larger opportunity to grow simply because they are not, very, very large. So their ability to grow their top line, their ability to extract efficiencies of scale from their operations, from their financing, from their customer relations, from their suppliers, all of this kind of builds up as the company gains size. So our sense is that, if you can find small caps which are interesting, you can make a lot of money over a period of time. And that's what even history tells us.
Are there any particular ideas that you're excited about right now in your portfolio?
Yeah, I mean, our fund has roughly about 22 stocks at the end of April, and I would say we are really excited about all of them, in different ways. For example, one of the most boring industries in India is cement. And we're very excited about cement because we believe that the kind of work that's going on in infrastructure development and the kind of income that should get generated over a period of time, we should see a revival in real estate. Not a lot of capacity is coming online. Cost of new capacity is roughly about $110 to $125 a ton, and you can find mid-cap companies really well managed where the enterprise value is closer to $70 a ton. And if you buy something at $70 when the cost of replacing that asset is $125 and you're buying a debt along with it, then your equity value has a significant upside. So we own 2 cement companies in the portfolio. We're very excited about that. We own a small real estate company based out of Ahmedabad, where the net asset value is somewhere in the region of 2,500 to 3,000 crores of rupees, and the market cap is just about 650 crores of rupees. It's a huge discount to net asset value. The management has a very strong track record of building and delivering projects. They're very well liked as a builder in the city of Ahmedabad, very focused. So we felt that there was just so much value on the table that we wouldn't mind buying it and waiting for 3 years if that's what it takes for us to unlock that value.
I also remember that you have clear frameworks within your philosophy to identify companies. I mean, what I last remember is you have 4 different buckets. Could you tell us a little more about that?
Yeah. So again, what we did at one point in time, 2 years ago, when we started thinking about the fund, we said, okay, we're going to dig out all the stocks we bought and sold through our history and see what has worked and why it has worked. And we found that there were some 4 or 5 underlying themes that worked for us. So one is, like I mentioned, buy good businesses going through a bad time. That is an invariable winner, unless your analysis about the good business itself is wrong and it's not a good business and you think it's a good business. Barring those situations, they reward you extremely well. The second area is when you can find a huge amount of pessimism about a stock in the marketplace, which doesn't gel well with what the reality is. So, for example, I have a strong belief that you can probably manage your profit and loss account, you can probably manage your balance sheet, but one thing that you can never manage is your cash flows. So we pay a lot of attention to cash flows. And usually, what happens is that there's a huge amount of disbelief, in a stock, and you see their cash flows and the cash flows seem fine. And at that point in time, you have to, sit up, take notice of that and say, okay, you know what, I'm going to buy this because the cash flows are a lot stronger than what the market believes at this point in time, and therefore you should buy it. So one of the stocks in our portfolio, for example, today is J. Kumar Infrastructure. At one point in time, it was banned for trading by SEBI as a part of 331 companies that were said to be shell companies. Being a resident of Mumbai and looking at their projects, we knew it wasn't a shell company, so that part we knew. But then we did our investigation, looked at the stock, and we felt that the stock price, once it started to trade again, was trading close to book value. It had never gone below book value through its trading history. The business was real. We went and spoke to the company's customers. We went and looked through the balance sheet in great detail, tried to figure out what could go wrong, and our sense was that at book value there was really not much to lose, and we bought the stock, and it gave us handsome returns even through till today. So so if there is a huge sense of disbelief and the numbers don't back up that market disbelief, then you should be willing to buy it. The third thing is if you can buy a young business in a young industry with a long runway to growth. These businesses over a period of time can deliver exceptional value as the market grows and as the business grows. Very early on, in my career as a money manager, we purchased Page Industries. It's a very popular name today. But we bought it, I think 2 or 3 months after the IPO. The stock had fallen because the overall 2008 market was what it was, and we accumulated about 3% of the company in our small cap fund. It wasn't very liquid, so you literally had to buy a few thousand shares every day or a few hundred shares every day, and we kept accumulating it. And we just felt that it was a very, very young industry. So it's a very well penetrated industry, but in terms of branded, a shift to brand or a shift to an aspirational brand, we felt that India was fairly young in that journey. So we bought the stock when it was trading at less than 10 times forward multiples. We put a fair price on it of 20 times forward multiple, and 2 years later we sold that investment, which was about 3x from where we bought it. In hindsight, of course, we should have kept it, but the fact is that if you buy a young business very early, that does very well for you. So these are some of the ways we look at things.
Just taking a cue from what you mentioned earlier, often a lot of these companies that you buy are going through a rough phase, so they may probably drop more in the immediate term before you start seeing some signals of turning around. How do you mitigate the risk in the portfolio, and what do you think should be the ideal time for an investor to give you money?
Yeah. So the only thing, so there are two parts to value investing, right? One is that you have to figure out why the street doesn't like the name, or what's wrong with the company or the stock at this point in time. And then you have to build a thesis as to why that problem is going to go away over a foreseeable future. And foreseeable future, my sense is about 3 years. You really can't look out 5 years or 10 years. It's very, very difficult to do that. But 2-3 years, it's possible to look out. So if we can find that there are certain circumstances which the company is facing, but the company is taking some steps which might lead to a better future in the foreseeable future, then we are willing to buy it. The second question is, how do you size the bet, and how do you buy a stock that is continuously falling? Okay, so in theory, if you like something, you should just buy it at that price and not worry about it. But in practice, what happens is that if something is coming off every day, then when is a good day to buy? So then what we've tried to do over a period of time is to buy it in steps. So you first buy 20% of your position, then you buy another 20%, another 20%, another 20%. So try and get invested over the next 2 or 3 months or something along those lines. So hopefully, either the stock will go down and you can get successively lower prices, or if it bounces up, you missed a little bit of the opportunity, but at least you didn't go all in. So you try and do that. That is a second way you try and mitigate some of that risk. Having said this, there are several situations where we buy and then the stock goes down another 30-40% from there because, as like I said, a value stock is a value stock because there is something wrong with the company at that point in time and people don't like it. And it is quite possible that from the point you buy it, another couple of quarters or another year and a half may turn out to be very bad. And you just have to bear it. So long as your investment thesis is on track, you should continue to hold it. And so what we bring to the table, I keep telling my colleagues, is that the only thing that you can bring to the table is not, you don't know more than the market knows more than you. I mean, that is a given. Okay, the only thing that you can bring to the table is patience, because patience is something that the market participants may not have, but we have. So if you're willing to hold on for 3 years and you're willing to give up performance in the short run, then hopefully, over the long term, you could make more money.
So Ashwini, you have vast experience of investing in equity and capital markets. One of the questions we keep getting asked most often is, when should you invest in equities? I mean, this question about timing. Now, you've been investing in equities for a long time. What advice would you give investors who want to invest in equities?
I'm a big believer of asset allocation, and I think there is no right time or wrong time to invest in equities. And again, you have to look at returns from a long-term perspective. I have been an equity investor all my life, and my equity allocation or my allocation towards equity personally has always been reasonably high. The only thing that you can do is, if market is really expensive, take it down a notch, and if the market appears really, really cheap, take it up a little bit. So though you play within a certain band. So for example, let's just take a few numbers. For a young person who's in a job, in a stable job in a good company in his early 30s, I would recommend that he should have at least 80% in equities of his financial assets. And if the market is really expensive, really toppish, you can pare it down to 70 or 65 and then go back in and take it up to 80. I mean, that's something that I would say is nothing wrong with that. But to go to zero equities or go to 100% or even over 100% through leverage because you're trying to time the market, that doesn't make sense. Because when you do that kind of large asset allocation change, then you've got to be extremely smart and be extremely lucky, because luck plays a huge role in investing. I mean, we can say whatever we like, but the reality is that there is a certain element of chance of that whatever you think about as a future, as the outcome, possible outcomes, something else can happen, something totally different can happen. And that's why timing the market doesn't make sense. I mean, the fact remains that we are in an economy which in nominal terms is growing in double digits. Okay, so if you are a smart company, you should be growing a lot faster than that. And if you assume nothing else, the market should track the aggregate earnings of the corporate sector. If you look at long-term returns in India, they've been very, very healthy in the high teens or so over a 20-30 year time frame. So my point is, why time the market? Don't time the market. Buy a strategy you like, buy a company you like, buy a stock you like, and then stay.
Get your asset allocation right, have patience, and don't time the market.
And don't time the market. And asset allocation, I think, is the biggest piece of the investing that an individual can do.
So in that context, from a valuation point of view, where do you think we are at the current state of markets?
In the current state of the markets, with earnings recovery around the corner, or we are undergoing an earnings recovery, I would say you're somewhere in between. So I wouldn't say that I'm bearish today, especially in the mid-cap universe, which is where we invest. I think we've seen a significant correction in 2018. I mean, in our December newsletter, we had written to investors that, 2018 is going to be a tough year for returns. And at best, you could expect only 5 to 10% at best return from the marketplace. I wish I wasn't so right, but in hindsight, valuations were expensive, but today they don't seem so expensive to me. Are things as not that bearish? I don't think things will fall 20-25%, but these are markets, you don't know.
So Ashwini, I mean, you have close to 26 years of experience in equity markets. Could you tell us any instances or particular experiences which have shaped your thought process or your investment philosophy?
So like I said, the market teaches you lessons. Okay, you keep learning every day. The only thing you can hope to do is not make the same mistake again. Okay, so whatever we have learned over the years is because you've made certain investments and because they have worked for you or not worked for you. They teach you a lesson and you try and implement it. So for example, the only thing that the Maruti lesson taught us was that if you believe what you're looking at is a good idea and a good story, don't worry about what the rest of the street is saying. Live with it, go through it, and time will prove itself. In some of the you had earlier asked me about a question about have you faced any failures. So one of the biggest failures that we had was MT Educare. We bought this stock in 2013, if I recall right. No, 2012, when the stock was already down significantly, and cash flows were robust. Everything was looked rosy from a historical analysis perspective. But there were a lot of things changing in the way the supplementary education business was working, and the kind of choices that the company had made. And somewhere, we got it wrong. And it's very funny, and I'll tell you the lesson that we arrived at. So we had purchased the stock around 77 or 78 rupees, somewhere there, and there was a point in time when the stock went up to 180, 190 rupees, and we sold some of our position. I think we sold 20 or 25% of the position. And then they were launching RoboMate, which was essentially an online app-based education B2C kind of a reach program. And we ran some numbers around it, and it looked like a very, very nice opportunity to us. And we said, okay, let's hold on. And that again reinforced the belief that I had that you should sell at fair price. We made a mistake. So RoboMate was an open-ended bet. There were no definite numbers around it. And what we should have done was just looked at our valuations and said that, look, it's done what we wanted it to do. It's doubled in less than 3 years. Time to go, and we should have gone, and we didn't.
So, developing a contrarian streak of thinking requires some amount of discipline and as well as temperament. Is there some way that one can inculcate that, or at your end, what is it that you have kind of built in terms of a system?
So what we do is we keep screening So the first thing that we do every week religiously is go through the 52-week low list. Okay, so these days it's a long list. Okay, but there are times when the list is just about half a page long or not even that. So you go through the stocks that are trading at 52-week lows, and having been around and having met thousands of companies, 80-90% of the list you can just names you just reject basis your thinking about those companies or the history behind them, etc., etc. But then there'll be these 4 or 5 names that will pop out at you and say that, well, this deserves a little more work. So that gives, I think, the simple act of going through that list and finding good companies on that list gives me the hope that we are on the right track. And these are, some of these are very well loved companies. I mean, I'll give you an example. One of the companies that showed up on this list 2 weeks ago is DB Corp. I mean, it's a publisher with very high ROCs and ROEs historically, free cash flow generation, promoters who've done a marvelous job in publication of newspapers, and the stock is at 52-week lows. Obviously, it's going through a tough time. There is the newsprint costs, and the advertising market has been very, very soft, and so on and so forth. So a whole bunch of things they're facing some challenges for sure. But that's what keeps you there. So you say if somebody like DB Corp can get there, and they are smart people, so hopefully they can figure out a way to get out of there. Then you look at it and you say, okay, fine, let's look at it. So the hard part is sometimes ignoring the noise, and sometimes also, that left out feeling that you have when stocks are running up, you don't know why, and you don't own any of them. That can emotionally be very straining at points in time. But the only thing that you can do is keep the discipline, revisit your investment thesis. So we write our investment thesis down, we present it internally to each other, and what I found is that writing down the investment thesis gives you clarity of why you own a stock. It's actually when you put pencil to the paper, that's when your arguments kind of are formed in clarity. Till then, it's just a woolly story. You go and meet a company, you really like the management, your stock is down, significantly off its highs, it's on a 52-week low list, optically the valuations look interesting, all of that is fine. But till you pen down the reasons as to why I want to own the stock, okay, you will never be clear about the investment thesis. And in times of trouble, the only thing that you can do is pull out your investment thesis, relook at it, and say, okay, do these reasons still stand? And that's what gives you the confidence to hold on.
Interesting. So the domestic fund, how big is it?
250 crores at this point. It's open for subscriptions. We have a monthly opening and closing. So at the end of any month, investors can subscribe.
Lastly, at Motilal Oswal, we are all avid readers. I mean, going with our tagline of knowledge first. Are there any books that you would advise, investors so that they become better at what they do?
It's a very broad question. So I have read a whole bunch of these books over a period of time. I can't say that any one of them has added a lot of value, but in sum total, they add a lot of value. So the only thing that I tell people is read, a good financial magazine. So Economist is my first go-to magazine. So I would say that people should read that. And in addition to that, people should try and read at least a book a month. I mean, a lot of people would say a book a week, but book a week is very, very hard pace. I mean, I know people who can do that, but I certainly can't do more than a book in a month, or maybe 2 books in a month if I get some time off. But people should read. They should read fiction. They should read non-fiction. They should read all kinds of stuff, because building a perspective of history, building a perspective of economy, are both required for you to be a good investor. And there's so many books. So one which have nothing to do with the markets, but they give you insights. It gives you insights about people. It gives you insights about places, insights about history, which become relevant to investment decision making. So that's what I would say. Read extensively.
So with that, thanks a lot, Ashwini. It was a very insightful discussion personally for me, and I'm sure our viewers also have a lot of takeaways.
Thank you for having me here.
So that was Ashwini Agarwal, who's head of equities for the Ashmore Group in India. He also manages the Ashmore India Opportunities Fund. A lot of takeaways and insights from this discussion. The top 3 from takeaways I would say is: have a clear philosophy or discipline of investing, have patience, and if you think your hypothesis is right, stick to it. So thank you very much. If you would like to write in to us, please write in to us on our email ID, follow us on Twitter, or watch our YouTube videos on our YouTube channel. Thank you.